Let's start, shall we, with Whirlpool, where the shares are down roughly 5% in the past month. Home improvement spending slowing. Whirlpool cutting costs to ease margin pressures. What's your thought on Whirlpool?
Yeah, Tyler, so our thought on Whirlpool is that it's actually scoring the bottom decile for expectations. Analysts have been downgrading the estimates for Whirlpool to the tune of about 11% since November. Also, the profitability is in the bottom decile. Whirlpool has been, revenue has been flat for 10 years. The margins are declining and supply costs are going up. So we actually have a very negative view of Whirlpool because we don't see a catalyst for revenue nor profitability growth.
Some things, sometimes companies that are in the bottom decile are destined to stay that way for quite a while, I guess, right?
Exactly.
All right, let's move on to Diageo. Shares of the U.S.-based alcoholic beverage company down 16% in the past year. Who's not drinking? B of A downgraded the stock to neutral, citing the slowing sales in the U.S. in particular. Consumer trade downs, foreign exchange headwinds. You say, Digas, that this is still a buy for you.
It is still a buy. We saw some weakness also in the Latin American markets. However, the profitability is actually in the top decile. It actually has a net margin of 22%. It has a very attractive 3% dividend yield. And also, let's look at valuation. It's coming in about 15 times, which is well below the 20 to 25 range. And also, it has 7% revenue growth. We like its strategy of focusing on high margin, premium brands such as Scotch, the vodkas, the gins. We really like the company, and we think it's well positioned.
You think it's well positioned, but what about the trend that people are imbibing less and choosing other kinds of drinks?
What's happening is that they're also focusing on trying to take larger market share. Believe it or not, even though it is one of the top brands, it only has about 5% of market share. So what they're focused on is increasing that market share. And the market is believed to grow about 9% a year. So if they can expand their market share with a growing of about 9%, it will still be a company that's going to generate free cash flow.
All right, finally, let's move on to UPS, which was the mystery chart we showed earlier. Shares falling 16% in the past 6 months since reaching a deal with the Teamsters. And while Barclays notes labor inflation will be more manageable, near-term risks include lower Amazon volumes, increased efficiencies at competitor FedEx, among them. Digas, is there still opportunity at UPS?
It's still opportunity at UPS because we're long-term holders of UPS. And so what we're seeing is that even though with the pullback in the last year or so, it still has free cash flow of about 10 cents for every $1 invested capital. It has a very attractive dividend with a dividend yield of 4%. And so we are seeing that they're focusing on the labor efficiencies and also trying to grow the global markets. So we see as a long-term investor that this could be an opportunity to buy at these levels.